Hello, and welcome to the Commercial Real Estate Talk podcast. I'm your host, George Morales. Thank you for tuning in to this weekly look at commercial real estate news. We track commercial real estate so you can focus on your business. This is episode 128. We've got two main stories to get to. We're going to jump right into it here shortly. $2.2 trillion in maturing commercial real estate loans. Why should you care about that? How will that impact you? Stay tuned. And second, flight to quality. Now, if you haven't already, if you're not familiar yet, we have a new channel, essentially new channel, last 30 days on YouTube called the Commercial Real Estate Talk channel. So I'm going to mess up from time to time. I'll say Commercial Real Estate Talk podcast, Commercial Real Estate Talk channel. But let me give you a little sneak peek. And we've got more and more content popping up on the channel, and we've started these little commercial real estate how-tos, know-hows, shorts. Okay, they're learn commercial real estate in under 60 seconds, and we're starting to put a nice little collection together. If I count right, that's 7. Anything from what is an SNDA to usable square footage to what is a cap rate, flight to quality. Some of these we're going to talk about today. To what is TI, parking ratio, ROFO. We've got more coming, God willing, in the near future. We're going to try to pump out 1 to 2 of these per week. So please, that is available for, hey, it doesn't cost anything to go to YouTube and subscribe, right? And yeah, please do encourage you to subscribe if you're getting good information from the content we're providing. Let us know we're doing a good job. Leave a comment. Give us a thumbs up. But this podcast is a resource that is available by video on the Commercial Real Estate Talk channel. Also, if you haven't yet visited don'tsignthelease.com, you can pick up a book on commercial real estate that I authored, Commercial Real Estate Office Leasing. If you like what we're doing with the shorts, you'll love the book. It's going to take you a deeper dive into commercial real estate. If you're new to the business, what a great way to learn. The glossary alone is worth the investment. So right now, it's don'tsignthelease.com. It's going to change very soon to commercialrealestatehelp.com, so stay tuned for that. But let's jump right in. We value your time into this first subject that we're going to discuss, $2.2 trillion in maturing loans, and that's thanks to this article from BizNow. Thanks to this article from BizNow, the $2 trillion wall of maturities is being climbed behind closed doors. I don't know about you, but that's a lot of money, right? Take a 2, and how many zeros do you have to put to get to trillions of dollars? That's a lot of zeros. I haven't tried that. I think it's 12, maybe more. All right, let's get into the article. It says, with a record $2.2 trillion in commercial real estate loans coming due in 2028, nearly $1 trillion is expected to mature this year. Now, this article came out June 23rd. I'm recording this the night of June 26th. It's going to be posted, God willing, June 27th. So we're talking about July, August, September, October, November, December, 6 months. There's $1 trillion expected to mature this year. There have been some expectations among investors that a wave of distressed assets would hit the market. So that's what the market is concerned about. That's the talk about commercial real estate, especially office, right? With all this maturing debt, whoa, the sky's falling in commercial real estate. People are running away from commercial real estate. Is that really the case? Well, let's get into the article. This hasn't quite happened yet, as transaction activity remains at cyclical lows. And rather than during the global financial crisis, when lenders were packaging up anything and securitizing it, the recovery from this market downturn will look different because of the increased variety of lenders. MSCI Real Assets Chief Economist Jim Costello said last week to the National Association of Real Estate Editors. So this essentially is an interview of Mr. Costello, and we get his opinions. People are saying, oh, it's going to fall apart. It's all going to fall apart. We're going to see prices fall and all the loans go bad and the commercial banking system fall apart just like before, Costello said. But the conditions are different this time for a number of reasons. Okay, Mr. Costello, let's hear. Roughly $600 billion of commercial property loans are due to mature this year, according to data from MSCI. The largest chunk of these maturities are CMBS loans. Those are commercial mortgage-backed securities. But MSCI's data predicts that maturities on investor-driven loans will outpace CMBS maturities in 2025. CMBS maturities are publicly traded instruments, meaning the debt services handling workouts must provide transparency. So these are publicly traded. Everything that public entities do are by nature public, right? So whatever wheeling and dealing they're doing is going to be done in a public manner. There's a lot happening in the background besides what's happening with maturities that we can't track. Costello said. All right. So there's a few things that he gets into the article. He talks about extend and pretend tactics that are taking place. And he says that there are structures happening in the background to resolve these distressed situations. And don't worry, we're going to get into this a little deeper. But one of the ways he said lenders have been skirting the impending doom accompanying maturities has been to recapitalize a fund and sell it in secondary shares. Costello said, while that creates some dilution within the fund's value, it creates enough equity to make refinancing deal work. Another method currently being used is banks selling off portions of loans at a loss to avoid larger losses down the line, Costello said. The most recent example is Washington Federal Bank selling $2.8 billion in CRE loans to Bank of America last week at 92 cents on the dollar. So I'm not sure I'd be a happy Bank of America customer right now if you knew that they are picking up distressed assets or loans. I'm not sure I'd want to have my money tied up with them. All right, so let's break this down. Why should you care about $2 trillion of maturing loans? Okay, why should you care? Well, for a host of reasons. But remember, when it comes to commercial loans, they don't operate the same way as residential loans, right? When you go buy your house, you usually have to put 20% down, right? 80% is going to get financed, so you have 20% equity in. 80% is going to get financed with whoever, and you're going to get a fixed rate most likely. You can either get an adjustable rate mortgage, which, maybe now is a good time to do that. I'm not a financial advisor, but everybody thinks rates are going to go down. But essentially, you're going to lock in a rate for 30 years. Let's say right now it's 8% or 7.5%. You're going to lock that in. So every month you're paying in the earlier years more interest, less principal. As the mortgage continues through the years, it sways. So now you're building more equity and paying off the debt. That's how residential real estate works. Commercial is far different. Now, you still will have in commercial real estate an interest rate. Let's call it 8%, 7.5%. You still have amortization. Instead of 30 years, probably 20 to 30, somewhere in the middle. Let's call it 25. But most commercial loans are done with a interest-only payments for the first 5 or 7 years. Why is that? Because commercial real estate is always done with other people's money. You get an investor or a managing partner, and then he brings in a financial equity piece, call it a REIT or call it an institutional owner, and they'll come in with the equity. Now, with the equity that's needed in commercial real estate deals is typically 30 to 40%, more like 40%. In some cases today, I'm hearing 50%. That's a lot of money. A $100 million building, you got to come up with $40 million. So usually you have a very small partner that has maybe 10% of that $40 million, about $4 million in the deal. The other $36 million of equity, he's going to raise it through a fund, through an investor, through an insurance pension fund, a REIT. They're going to kick in. And then the balance $60 million or 60%, that's going to be filled in with a lender, okay? They're going to have the number one stake in the building if there's ever a default, right? Not the equity piece. It's going to be the lender. But so the lender is going to require 40% down. There's going to be an amortization rate. It goes over 20 to, say, 25 years. But the first 5 to 7 years is going to be interest only because these property owners want to maximize their return. The less money they have to put in, the more they can take out, if that makes sense. What happens at the end of 5 or 7 years of interest-only payments? Well, the whole mortgage is due. It's called a balloon payment. So that's why you see these commercial buildings every 5-7 years selling or refinancing, because you do it all over again, right? You pay interest only. Theoretically, rates continue to go up. Occupancy continues to go up. The building increases in value, and now you can refinance all over again at a higher number, pull money out because you don't need as much equity in it. So you can pull money out, or you sell it and make a profit. That's why these commercial buildings usually trade every 5 to 7 years. If you ever wondered why they don't hold on as long as homeowners do, it's because of the way they're financed, the way that they're leveraged is another way to say it. So what did I say? That little game that's played in commercial real estate presupposes that occupancy stays where it's at or goes up, and rental rates stay where they're at and go up, and the building increases in value. Again, commercial property is not like residential property. An appraiser doesn't go out and say, does this building have a pool? Does this building have the same square footage? Does this building have this? What were the sales in a recent area? No. Commercial properties are sold as a financial investment, which means they look at the rent roll. They look at the cash flow. They look at the operating expenses. They get to an NOI and so forth. Hey, if you want to know what all these terms mean, I encourage you to go subscribe to the Commercial Real Estate Talk channel and hit those shorts, because we're going to hit all of these things in a minute or less. But it's basically a financial mechanism. How much rent, how much income does that building produce? That's the value of the building. And we'll talk about cap values in a future podcast and so forth, how to do that. So what happens? You got a loan 4 years ago, 5 years ago, pre-COVID, and now you've been paying interest only at 3.5% interest, and now the mortgage is due. And now you go back to the financial world, you go back to the lenders and say, okay, I need to do this game, I need to refinance. And the lenders say, well, wait a minute. First of all, the rental rate, the interest rate is no longer 3.5%, it's 7.5 or 8%. And oh, by the way, back 5 years ago, your building was worth $100 million, but we've noticed you were 90% leased at $60 square foot rates 5 years ago. Today you're 75% leased, and rental rates are $45. So we can't give you the same $60 million because your building's not worth $100 million. Your building is only worth $60 million now, and we're going to give you 60% of that, which is $36 million. You see the problem? So you've got a property owner who had a $60 million mortgage, and his building has gone down in value because he's lost occupancy thanks to, I don't know, the pandemic, work from home. We've had some major events happen. Folks are renewing, but taking 30-40% less space. So all of a sudden, his building is worth less, and the lender's saying, I can't give you the same $60 million. I can only give you $36 million. And by the way, that $36 million is no longer at 3.5% interest. It's now at 8% interest. So you have all kinds of arrows lining coming, being launched at these property owners. And so the property owner has a choice. What do? I have to, in order to refinance, I can't get $60 million anymore. I can only get 36. That's a $24 million gap. That means my building is worth less. It's less occupied. I'm not getting the same rents, but I'm going to have to spend another $24 million if I just want to keep this building. You talk about the returns tanking. That's what this is highlighting. That's the problem that lenders and property owners are going to see between now and 2028 is you've got to refinance at higher rates, a building that's worth less because of the occupancy and the rents. Who's going to get stuck with this bad potato, right? And we're already starting to see some institutions say, here, Mr. Bank, here are the keys. You can take them. I thought I had my keys in my pocket, and I don't, so apologize about that. But here, you take that problem. But we're not sinking more money into a bad situation. And so this is what everyone's paying attention to, and I think rightfully so. And listen, if you're an office tenant primarily, or any tenant, you should know what's going on at your property. You should know what the debt structure is at your location, because is your building part of this $2 trillion worth of debt that's soon to expire at higher interest rates and lower occupancy? You could be in for a rough ride if the lender and your property owner have to duke it out in court or get foreclosed on. And things like loss of services, things like building gets frozen, leases get canceled, rental rates get increased. There's a whole smorgasbord of negative things, and maybe we'll have an attorney on board one day to talk about this situation, because you really need to understand what happens in the event that the lender takes over the building, because that's what's going to start happening. And but believe me, lenders don't want these buildings. Lenders are like, listen, we're not in the business of running a 500,000 square foot office building in a troubled market. You stay on board. Let's blend and pretend. See, that's what the article said. The lenders are like kicking the road down the road. I know it's due next year, but hey, we'll give you a 12-month extension. maybe things will. Maybe we just put our blinders on and hope things work out. That's what's happening right now. There's wheeling and dealing because nobody wants to get stuck with this. Everybody's hoping that when the Fed finally starts to lower interest rates, that the economy will perk up, inflation will get out of control, people will expand, and it'll be business as usual. Occupancy will rise back up. Rental rates will get where they want to be. And then we can keep this little game going again, right? Every 5-7 years, refinance or sell. Not so fast, in my opinion. We've got a $2.2 trillion to work through the system. And that's why you should care about maturing debt. You're going to hear a lot about this in the news, maturing debt, and why this has a potential, think about it, not only to drag down commercial real estate, but this debt's all with banks. It's going to drag down the banking system. This has a chance to drag down Wall Street. This has a chance to drag down the entire economy and to a scale that is far higher than what we saw in the Great Recession. So that's kind of worst case scenario if we don't have a soft landing in this, if the lenders and the property owners can't come up with some viable opportunities here to handle this in a way that's less painful. There's going to be pain, but are you going to be stuck in it now as an office tenant? You need to know. And again, let me encourage you, contact us. How do we pay the bills here? How do we host this podcast? Because we have a commercial real estate company in South Florida, headquartered in Miami, called Blue Box Real Estate. We are an independent, best-in-class commercial real estate firm. We specialize in tenant advisory services, landlord advisory services, and investment sales. We're happy to look at your lease, compare it to market. And today, more and more, it also includes looking at the debt structure of your building so we can stay ahead of the curve, so we can ask the right questions, and so that maybe we can talk about an SNDA if you don't have one already. If you don't know what that is, I've got a little short that you need to take a look and listen to. All right, so that's the first article we wanted to discuss. It's a big deal. I don't know if I've made it a big a deal enough, but I think every week we could cover another story about this maturing debt. We did a short last week on flight to quality and what that is and what that entails. And then CoStar must have, I don't know, maybe they're a subscriber to the Commercial Real Estate Talk channel, because out came this article a week later, and it's entitled, Newly Built Office Buildings Hang On to the Greatest Demand. Office tenants still fill new construction, but leasing pace may be slowing. And for time purposes, I'm not going to read every little word here. And there's a beautiful picture of Boston, brand new, beautiful building. So if you're not looking at the video, you can't see it if you're just listening. But the office market since 2020, the article goes on to say, let me summarize a little bit of it. Before 2020, older buildings, Class B buildings, 30-year-old, 40, 50-year-old buildings, everybody was doing great. Economy was great, greatest economy of all time. I mean, things are bad. Everybody's doing great. What happens? Pandemic hits, boom. Economy tanks, people have to work from home, which is still continuing today, still impacting. And so what do we see happening now? Since the beginning of 2020, buildings older than 10 years have lost nearly 420 million square feet of occupancy, an amount roughly equivalent to all the office inventory in the Dallas-Fort Worth metroplex. It's like we had an entire market disappear. That is the problem. And that's a quote from the article. Older buildings are suffering the losses in this cycle. The article continues, this occupancy loss far surpasses anything, let me scroll up here, observed in previous economic cycles. The difference goes beyond magnitude, revealing new tenant behaviors as occupiers make long, slow adjustments to new ways of using space. I'm going to leave my short to answer what flight to quality is. But let me say, I'll probably come out with a new short because there is a second type of flight to quality that's occurring right now. And that is, what happens if you're leasing 10,000 square feet, but you're only using half of it? Because you've got employees on an alternating basis. This one comes in on Wednesday, this one on Thursday, this one on Friday, 2 days a week, 3 days a week. And now you have 10,000 feet and your lease is expiring at the end of this year. You have 10,000 feet at an older B building, a building that was built 40, 50 years ago. And let's say you're paying $100,000 for that 10,000 feet, $10 a square foot. Make believe, but let's just pretend. And now your lease is due, and you're thinking, you know what? I don't need 10,000 square feet. You have two options. You can go and, more than two options, but let me narrow it down to two options. You could go to your current landlord in the B building and say, hey, I don't need 10,000 feet. Find me a 5,000 square foot space so I only pay $50,000 a year, not $100,000 a year. That's option one. Option two, I can afford $100,000 a year in annual rent, but I don't need 10,000 feet. I only need 5,000 feet. So let me go shop around and see for 100,000 at 5,000 feet what I can find in a newer Class A building. That's option two, is what's happening right now in the market. Tenants are electing to upsize, fly to quality, go to newer, higher grade Class A buildings, but take less square footage and keep the monthly cost the same because they don't need as much square feet now. Why would they do that? Well, who's coming into the office every day in companies? Okay, the staff gets to work 2 or 3 days a week from home and 2 or 3 days in the office. Guess who's not doing that typically? It's the decision maker, right? The CEO, the president, the head attorney, the partners of the law firm, partners of the CPA firm, the marketing agency president. They're typically still coming into the office, and then they want to provide more of an incentive so that when their employees come to the office those few days a week, they're wowed. They're excited. They're there. They're not missing home. They have a brand new built out office, beautiful views, all the amenities that come with newer buildings, which includes restaurants, perhaps a gym, conference center, meeting spaces, Wi-Fi areas, pickleball, whatever it is. It's attracting them to the office and encouraging them to stay and be productive while they're there. The newer buildings are designed for the newer tenants and how they're thinking today, whereas these older buildings are stuck. Many of them, they're just functionally obsolete. They don't have the space. They're not large enough. They weren't built considering pickleball courts or conference centers or gyms or restaurants. And so right now, tenants are opting to get rid of their old space, get smaller space in newer buildings. And that's exactly what we're seeing and what CoStar is keeping track. Here's a great, maybe I'm in the way here. A pace of occupancy in new buildings is slowing down. Okay, so that's a concern. The article goes on to continue. Leasing volume for office space has slowed down. Okay, first quarter 2024, it fell 4% of inventory, a rate not seen since 2011. All right, absorption. So we're talking about absorption. That's the amount of space absorbed in the market. Slowed down to 4% the first quarter 2024. The 12-month average is down to 5%. We haven't seen these numbers since the Great Recession. So, yeah, look, it's one of the reasons, again, that is maybe it's not so much that the leasing activity is slowing down. It's the fact that the square footage amount is slowing down. And so, look, if you own an older B building, C building in the marketplace, and you haven't yet started to renovate and try to accommodate to the new users, it's too late. It's too late. And now, let me say the double whammy. If you're an older B building and you haven't yet adjusted to the new market conditions to try to provide and compete against a Class A building, and you have a maturity loan, you have a loan maturing in the next 2 or 3 years, that's a recipe for disaster. So if you're a tenant in one of those buildings, you really need to get a hold of a tenant advisor. Obviously, we raise our hands. We'd love to talk to you, love to understand what your lease looks like, when it expires, what your options are. You should want to understand what the market is, where the Class A rates are, and more importantly, what's the debt structure of my building so that we can make some moves here with time. So that's what we have for the podcast today. Really, we've got two main subjects that we're really tracking, and that is $2.2 trillion of commercial debt coming due. Are you in one of those buildings? You really need to know. And second, flight to quality. What your neighbors are doing, why you're seeing vacant spaces on your floors, it's not just because businesses are all collapsing. It's because they're partying over at the newer building down the street and leasing less square footage. That's what's happening in the market. Hope that was insightful for you. Proverbs 20:18. We end with Proverbs 20:18 in these podcasts. Plans are established by counsel, by wise counsel, wage war. And we thank you for letting us be part of that. Please subscribe, like us, share us with others. Help us spread the word on commercial real estate. Thank you.